On the Express this week, the ripple effect of those rising oil prices is turning into a tidal wave. The good, the bad, and the ugly scenarios for the future of oil prices. John Kilduff of Again Capital drops in with some knowledge on that. Nowhere to run to, nowhere to hide in this stock market. And SpaceX is blasting towards the biggest IPO in the galaxy. And what to watch during a busy and pivotal week for investors, the stock market, the economy, and the future of the Middle East. Microphone check 1, 2. What is this? It's the Investopedia Express, always open for business. Welcome back and welcome aboard. Shout out to all the Investopedia Express listeners and watchers around the world. We know you're tuning in right now, all the Investopediacs out there, the smartest investors on the planet. Thanks for joining us on a Monday morning, the first full trading week of the second quarter. We had that holiday shortened trading week last week. Markets were closed on Friday. We probably needed a little bit of a breather there, but we do have markets on the rise going into a Monday morning. All arrows pointing up and to the right on news of a potential ceasefire between the U.S., Israel, and Iran. Just news right now at this point in time. We'll see if that turns into something bigger a little bit later. A lot of headlines over the weekend, a lot of threats, a lot of chaos. And while the markets were closed Friday, the oil markets were open and oil prices continue to creep on higher, creeping higher this morning, even despite those headlines about a potential ceasefire in the Middle East. We're watching those rising oil prices because they're affecting just about everything right now. Those ripple effects, you're feeling it. The ones you feel front and center, obviously gas prices, about $4.11 nationwide on the average here in the United States, about $6-7 out in California and in other places right now. But you're also seeing a 6% jump in natural gas prices, 7% increase in rice prices. Fertilizer prices are up almost 30%. Those are climbing higher. Urea, which you need to make fertilizer and you use in the fertilizer process, those prices are up 48%. Huge deal for soy and corn farmers, and diesel prices definitely a huge factor in food prices. Those are up 44%. We've already seen the impact on jet fuel prices, and we're starting to see this weakness was already building before the war in Iran, but this weakness in the U.S. economy, different cracks in the fissure along the way. But I'm going to focus on the consumer. I'm going to look at the consumer right now. Oil above $100 equals about $500 to $1,000 in extra spending per household. Now, some households were going to benefit from a bigger tax refund due to the tax bill, but that's essentially a wash right now with these higher gas prices. Personal savings rate is near multi-year lows, only 4.5%. And that's not crazy terrible like it was during the great financial crisis. That said, it is sort of alarming and it's on the rise. The average credit card balance is about $6,500, down a little bit from the $7,000, but still pretty high up there. But credit card holders in serious delinquency, 7%. That number's almost doubled in just the past few months when we got those high credit card APRs. And then consumers' expectations for inflation, we're thinking it's going to be 3.84%. Probably going to be higher than that if this continues on. And you're going to find out in just a few minutes in our conversation with John Kilduff, those rising prices don't come down as quickly as they rise. They say oil falls like a feather, and it sure does. Let's talk about those thresholds at which oil prices really start to take a bite out of the economy. $80 to $100 a barrel. Pressure on consumers and businesses for sure, but it is relatively manageable. We've been through these before, but you get to $100, $120 a barrel on a sustained basis, you got stagflation risk, my friends. Slowing growth, rising unemployment, and rising prices. No fun, no good for the stock market, no good for the economy. You get to $120 to $150 a barrel on a sustained basis, and you get real recession risk there. If you're looking for price increases, I told you about some of them, but they're everywhere you look right now. Smart chart here from our friends at Creative Planning. You got those rice prices, as I said, up 8%. Coal, 16%. Diesel prices, 49%. Heating oil prices, 68%. Not a problem as we go into the summer, but those natural gas prices bleed into utilities. And those utility prices, especially as we start cooling our homes, probably going to be a super hot summer as usual, as we've been getting for the past few summers. That's going to end up costing a lot to households. And we've already seen what the impact is on jet fuel prices. United Airlines, Delta Airlines saying that they're going to charge additional fees. They're going to add on to baggage fees potentially. They're going to start maybe canceling some of those routes that don't pay off for them when they can't fill their planes. So you're going to see some scarcity and some higher prices for air travel, which means maybe less travel going into the summer. Not good for leisure and hospitality sectors and those communities and those cities and those places in the country that really require those as well. And as for the stock market, again, in the green today, choppy week last week, tons of volatility, but there's literally been nowhere to run to, nowhere to hide except for energy and defense stocks, which are the market leaders, as you would expect at a time like now. But you would also expect investors to be piling into value stocks when they're worried about the future of the economy. And we know the growth stocks and the tech sector and the AI stocks have been hit pretty hard, very hard. In fact, we've been talking about that show after show. But if you look at value stocks, they have turned down and to the right as well. Looking at the different indices here, that orange line is there. Those are your value stocks, right? Those are your go-to in times of fear, and that means like the Walmarts of the world, the McDonald's of the world, the Staples of the world, even some of the utilities of the world. Those value sectors that has turned down and to the right, and that shows you that investors are not that confident about the future of the economy with these rising oil prices. You look at that green line. Well, there's your energy sector up there. And that's where the money has been flowing. The problem is for index investors, long-term investors that buy ETFs and index funds, energy stocks are just about 3-4% of the S&P 500. So while those stocks might be surging, unless you own those individually or you own those ETFs directly and you've moved into them pretty heavy, you're not feeling the impact in the stock market, which is why the stock market is down, the S&P 500, around 4 to 5%. So far year to date. I think it would be a lot worse given the scenario, but it's not. The problem, again, is the concentration is still in mega cap and tech stocks and AI stocks, and the biggest stocks in the world. They're not the energy and oil stocks of the world. They're not the defense stocks, but they're getting bigger. And if energy stocks keep rising, they could definitely become a bigger part of the stock market on a market-weighted basis. But if that happens, my friends, that means these high energy prices are here to stay. Remember, anything over $50 a barrel for the oil companies is profit. When you get into the $80, $90, $100 a barrel, well, they're making money hand over fist, but it's costing us consumers and businesses a lot, and it will slow the economy, potentially into stagflation, potentially into recession. And we're hearing the drumbeat around the R word, the recession word, getting louder and louder lately here in the US and around the world. You got groups from the OECD, the Organization of Economic Cooperative Companies. That's about 30 companies, and the IMF and the investment banks and the think tanks. They've been steadily lowering their GDP forecast, their growth forecast, because of rising oil prices. And as this war stretches on and the Strait of Hormuz remains effectively closed, except for a few ships here and there, you're going to get uncertainty. And uncertainty means less spending, and uncertainty around what happens next is everywhere you look. And no one, and I mean no one, is prepared to provide clear answers. You won't get any at the White House or at the Pentagon press briefings. And how dare you ask for any? There's a lot of clapback happening in those rooms. But we at the Investopedia Express have our own special group of experts. And when it comes to energy and oil, we like to lean on our friend John Kilduff. He's the expert energy analyst I've been following for years and the co-founder of Again Capital. And he joins us now on the drop-in. John Kilduff, one of my favorite expert energy analysts and the co-partner of Again Capital. Thanks for coming back on the Express. Good to see you.
Good to see you as well, Caleb.
All right. What, from your understanding, and you and I are talking on Friday here, is happening inside the Strait of Hormuz now? We've heard about a few tankers here and there going up through from other countries being monitored. We've heard about signal jamming, signal spotting. From your intelligence network and from your understanding, what's happening?
Well, what's happening is that we are seeing some Iranian vessels get through to start off here. Not surprisingly, the Iranian actually oil production is maintaining itself at about 1.5 million barrels per day, and their ships are getting through. Certain other ships are getting through as well on a sort of one-off basis here, particularly Chinese flag vessels and a few others. The Greeks and Pakistan have also made arrangements. Now, these arrangements are requiring payment to the government of Iran to allow passage. So there's a new toll. There's a new de facto control of the strait, really. It's interesting that the strait is only about 20 miles wide. So normally that would be, your own waters of each country. But this has historically been an international waterway. Oman's on the other side, and what we're also seeing in terms of fleets or ships trying to get through is that they're not going through the traditional strait, the 2 1-mile wide highway roads, if you will, there, but they're hugging the strait, the Omani coastline to get through. But all of these are just half measures, or 1/10 measures, really, because we need the full open navigation of the strait, of those 2 1-mile wide passageways that I just referenced, because otherwise it's just a drop in the bucket. And I don't know if people are realizing it or not yet, but they're going to very soon. This is a energy crisis of the first order. This is greater than the supply disruption in the 70s, both of them in the 73, 79. And we are seeing the lack of supply finally start to register. There is no more liquefied natural gas coming through. The crude oil starting to be drawn down. You are seeing and hearing about spot shortages of diesel and other fuels in Asia. And you're finally seeing the U.S. pricing get bid up more and more each day as in reflection of those tighter conditions, particularly out in Asia.
Yeah, well, we've been talking on this show about backwardation, the fact that you see these spot prices, the price you pay for oil today shooting up here in the United States and definitely around the world to a much larger degree. But if you look out to futures, like you have to with a commodity like oil, those prices look like they're coming down back into the 80s by the summer. Is the oil market, do oil traders have this wrong? Because we all heard the president earlier last week saying this war may end in a few weeks, maybe a little bit more, but it didn't really resolve what might happen with the Strait of Hormuz.
Well, unfortunately, it is. Well, what the market's pricing in right now is that the strait will be reopened here at some point fairly soon. The backwardation you referenced is stark, one of the biggest ones I think I've seen in my career. For example, May crude oil futures on NYMEX finished up on Friday around 112. The June contract is 97. So you're talking about $15 right there. The November contract is all the way down at 73. I want to highlight, though, that before this all happened, that November contract, for example, was probably down in the low 50s, if not 40s. So we have installed at least $20 of war premium here in prices across the board. So yes, those prices are marginally lower, but they're not where they were before this all happened. So yes, the pricing structure, the curve is indicating that we have a very tight front of the market, which we do. Fascinatingly enough, too, even just a few weeks makes a difference because not to get into too much inside baseball, though we can here, I think, on Investopedia,
Let's
that the
do it.
Brent contract had been above WTI pricing as right before the month rolled off, the end of March. Now it's below WTI pricing because now that Brent contract is for delivery in June. Okay, so and while the NYMEX contract is for delivery, obviously in May. So just in those, you're seeing just how much a few weeks difference is making for this market right now because of the hopes that were being clinged to about the strait being reopened and the burst of supply coming back on the market.
You know this region well, and you know that area very well. You don't just reopen the straits, especially after a disruption like this. And now we're hearing from this administration that they want to put the responsibility on European countries that rely more on this oil that comes through the Strait of Hormuz. But this is a global market no matter what, and we're all going to be impacted by these prices. It doesn't reopen just by the snap of a fingers, does it?
It doesn't. You're going to have to assure not only the operators, the tanker operators, and the insurance companies, but really everyone else to put Iran in a box that it can't reach out and inflict harm on ships transiting the strait is going to take an awful lot of effort if the government there isn't capitulating to that. And as far as trying to secure it militarily, as we've all now been digging into this, it's a Herculean task. Just the Strait of Hormuz, the sort of horseshoe landmass around the strait on the Iranian side there, it's mountainous. It's perfectly set up for Iran to defend itself and wreak havoc on the strait because they'll be shooting down into that waterway. So it's not going to be an easy task whatsoever unless and until the Iranians are truly, brought to their knees and are willing to say, okay, but you have ships that have been moored and now need to be sort of, made seaworthy again, if you will. And the other problem we have now increasingly is that countries like Kuwait, Saudi Arabia, Iraq especially, they have shut in some of their production. Turning that production back on, not an easy task because of the way they sort of run things. Our Texas shale guys, they're blowing up rocks and basically draining the oil out of these rock formations. In Iraq and out in the Middle East, there it's a much more sensitive, pressurized sort of extraction. Where if you lose the pressure, think of a balloon, or I use the idea of like if you put like a hose in a pool to drain it and put it over the side and it runs on itself. But if you mess with that hose, it'll stop. And that's kind of what we're dealing with these Middle East oil fields. And you're going to see that's why those prices in the back of this curve aren't bringing us back to the glut we were fearing back at the end of last year. They are pricing in problems for the return of the supply.
All right, take us through the barrel top to bottom because oil has much a variety of uses beyond just the gas we put in our car. I think people know that, but you know it well. And I want to talk about the pricing dynamics that happen from the top of the bottom to down the bottom, the crude part of it.
Right. It's to describe it, it's almost like I guess milk, right? So you put the cream off the top, that's the gasoline, and then you work your way through slices of the barrel. In fact, the old refineries would just run crude oil up into a big stack, it was called, heat it up, and this would the oil would break apart into these component parts that I'm referencing, all the way to the quote unquote bottom of the barrel where you get your asphalt and for the roads. But you're also obviously getting out of that some gas that comes off, liquid propane gas, the propane that goes into your barbecue, and which is heavily used out in Asia. Again, these cooking fuels, but also too petrochemicals or plastics. And so these feedstocks for the petrochemical industry are now going through the roof because of the price of crude oil going up, and they really can't pass those prices through as quickly as they would like. So this is going to be a bad time for the petrochemical manufacturers out there because of this feedstock increase. So you have your gasoline, then below that you have your diesel and your jet fuel. You have your heavier crudes now. The shipping industry used to burn what's called bunker fuel, not so much anymore. It was kind of banned, but it gets re-refined and all that. So this is what we're talking about. One barrel of oil makes a whole lot of things, and I think a lot of people learned a lot about this from Landman if they watched it, about just how integral petrochemicals and really crude oil are to our lives.
Yeah, well, stateside, we're not as reliant on the oil that goes through the Strait of Hormuz, but this is, again, a global product here and a commodity that trades 23 hours a day, 6 days a week, basically, right? This is something that, the pricing of what we actually see in crude oil prices and crude oil futures and the realities of what is happening on the ground or up and through the Strait of Hormuz are very different and mismatched often, right?
Well, they are, and so all and there's a famous political statement that all politics is local. Well, I always point out all commodities are too. So the United States and people are wondering, we're the biggest oil producer in the world by far. Why are we suffering from this? And that is because of what we just talked about. This oil can be shipped anywhere. So it comes out of the ground here in the United States, gets loaded on a ship, doesn't necessarily have to go out just to California or a local market. It can go to Asia. California is experiencing that right now, where they have to try to attract now international fuel supplies because of what's gone on in their state, refineries shutting down, oil production being shut in as well. So that's why the pricing out in Asia is pushing on $200 a barrel for crude oil, for diesel fuel, but not so much here. But it is coming our way. It's seeping into our market because the call for global supplies of oil, no matter where it is going to be increased because you can ship it. And we're reaching a point where forget about the price. You just want the supply, you want the volume, and you'll pay anything for it. And that's what we're on the doorstep of.
Yeah. Okay. Take me through the good, the bad, and the ugly of how this could potentially play out. I know it's really impossible to know that, but I also know you've been through some cycles here. Give us a quick play-by-play of what could happen in any of those cases. Let's start
Well,
with the good.
the good is that one of these many statements that President Trump has made of late about there being a deal and negotiations does come to pass, and some kind of arrangement is made, and the strait is reopened, and we can get the production back online, and things can settle down. That's the best case scenario here. The worst case scenario is that this does become a prolonged situation, and President Trump, for whatever reason, decides not to make one of the objectives, getting the strait secured, and now this becomes property of Iran, which is something we've never had to experience in this market ever. It was always fully an international waterway, fully navigable, nobody charging a toll or fees to go through it. That's the worst case scenario because there's going to be obviously high reluctance and maybe just a continued refusal by commercial interests to go through if they're risking attack by Iran. And then again, this is going to become an energy crisis of the first order that may require full international participation to get the Iranians to back off this threat of the strait because it's a stranglehold on the global economy. So that is the worst case scenario. The middle case scenario is sort of one where, things calm down, but the Iranians do hold on to some modicum of control over the strait, sort of a new dynamic for us all. And there are payments made to Iran by all the countries that utilize it. Again, not necessarily a United States problem, but it'll certainly be a problem for China and the Asian countries that'll feed right through to us because we buy all that stuff that'll now have a higher price component attached to it because of the higher energy costs that's going to result from this pseudo now Iranian domination of the strait. So those are the three for me.
Uh, all right. None of those sound great, but hopefully we'll get the good resolution will come to pass. But I also don't think it's going to be a quick resolution, and I don't think you do either. All right. Let's go out on this. The through line here, broader picture. When you think about U.S. foreign policy, when you think about what this administration has flagged and what they've actually put out there publicly, from Venezuela to Iran now with oil. This is obviously national in the interest of what they say national security, but it's control of natural resources. But don't we make plenty of oil already here in this country? And are we facing potentially another glut if all of this is resolved, let's say, before the end of the year, and all of a sudden the U.S. has much more control over global supply?
Oh, absolutely. Interestingly, ever since Saddam Hussein said it, I always like to sort of coin the phrase too. But there would be this could be the mother of all gluts. Particularly the Venezuelan situation for the U.S. That oil was really the the template for the Gulf Coast refiners. They built the refineries on the Gulf Coast to make shipping out the refined product easier, but also to receive heavy sour oil from Venezuela. That Venezuela's crude is of that type. Interestingly, our shale production doesn't match for as input for our Gulf Coast refiners. Really, they want a heavier sour blend, so that's why they usually get their oil mostly from Canada to the extent we're importing, and it's still about 6-7 million barrels a day of the 20 million barrels we process. So it's a significant importation. And the Saudis also have a refinery down there that they like to send oil to. But if this works out, where Iran as a threat to the region and threat to production gets taken off the board and becomes now more, comes back into the community of nations, and their production can get ramped up, and you have Venezuelans' productions ramped up, there'll be some other countries out there who are going to be left on the shoreline, eating their heart out, like Iraq, who has been underinvested for years, and Libya and Nigeria, who also need the petrodollars to save their economy. But yes, all of this is setting us up for a glut of, like I said, of the first order. Taking over the Venezuelan production and getting Venezuela back on its feet was very good strategically for the U.S. There's no two ways about it. How we went about it, you want to argue about that, you can, and the Iranians too. But I think what we're finding out here, or we're seeing why previous presidents were reluctant to go in and do what's been done because of the fallout here. And I am with you in that. I think this is going to take some time, and it's hopefully it doesn't turn into another morass like we had with Iraq. And the parallels are there. The military victory is assured. We're so superior. It's holding the aftermath or setting up the new country. I mean, remember all the IEDs, the rise of ISIS, all of that in Iraq. It was a nightmare. And it really actually kept the price of oil up because there was always threat to supplies out of Iraq, which are very important to the market. If you want a relatively low price of oil, we need Iraq supply. We need the Russian supply too. And that's what drove up oil prices in the initial invasion of Ukraine there. So, but this time, just to put it in perspective, we're losing 10 Russias basically right now. And we can't afford that. And that's why we desperately need this situation to resolve.
Yeah. Well, we don't know how or when, but I know I'll be following you to make sure we stay on top of it. John Kilduff, one of my favorite experts in energy and the co-partner of Again Capital. Thanks for coming back on the Investopedia Express, my friend.
My pleasure as always. Thank you so much for having me.
Great stuff there from John Kilduff. Again, follow him on all the social platforms, definitely on X, but also what the work that he's doing with Again Capital. When you really need to understand how it really breaks down, experts like John are invaluable. Thanks to him again for rejoining the Express. Been talking to him for years. All right, let's get to a little money in motion because it is out of this world. Well, last week, SpaceX, the company owned by Elon Musk, filed for a confidential IPO to raise somewhere around $75 billion. That could value the company somewhere between one and a half, one and three quarter, maybe almost $2 trillion if they continue to raise money as they head towards an initial public offering. It's been a private company for a while, tightly controlled, of course, by Elon Musk, like all the companies he controls. But this could be the biggest IPO of all time, surpassing Saudi Aramco several years ago, which was a huge IPO at the time. But the path from private company generating a ton of excitement, a lot of private capital, to becoming a public company, it is not that easy, not that smooth, which is why there are fewer and fewer public companies out there. Let's get through some of the basics here. Again, this could be the biggest offering in the IPO, biggest IPO in history. The confidential filing, in that they did not necessarily publicly put out a press release and file with the SEC that they would be going public. They did it confidentially. It allows SpaceX to keep financial details private internally and initially while the SEC reviews them. There's a ton of review that needs to go on. It's focusing on AI-related infrastructure. It's trying to build space stations out there where they can provide more Starlink satellite internet and rocket launches and potentially mine for rare earth or rare outer space minerals out there as well. But it's got a long way to go. It selected 5 banks to lead the offering: Bank of America, Citigroup, Goldman Sachs, JP Morgan Chase, and Morgan Stanley. Sounds like Wall Street to me, but these are the lead underwriters, and they'll assemble a broader group of banks to help sell shares to institutional investors worldwide. Retail investors like us, we won't get a taste of this till later, although you can invest in the private markets in SpaceX, maybe not directly, but then comes the roadshow. Let me just talk you through a little bit of the process here. Great article on investopedia.com about what has to happen next. Board approval, that's already happened. Assemble a team to take the company public, that's happened. Review and restate the financials, they've done that. Letter of intent with the investment banks, we talked about that. They've already done that. They're drafting a prospectus. They file confidentially. Lots of due diligence goes into this. Tons of lawyers poring over it. And also, the banks underwriting the IPO have to do their own due diligence to make sure what everything SpaceX says is actually true. Then you get the preliminary prospectus out there to the SEC, and the regulators are going to review that. Then you get syndication. That's when these banks spread out the offering to other banks to attract more institutional investors, which is why this could go from $1.5 trillion to $2 trillion pretty quickly. There's a lot of appetite for this company and this stock once it goes public. You're going to see those numbers rise. Finally, the roadshow. When you see these investment bankers taking folks out to really expensive lunches and golf resorts and trying to sell the IPO, that's called the roadshow, and that requires some time and money. Finally, the prospectus finalization, the determining of the offering price, and then the final prospectus printing, and then the IPO. So it's not like you snap your fingers and you go public unless you do it through other means, like a direct listing, but this is the way actually big companies do it. So the largest IPOs of all time, I mentioned it before. You had, of course, you had Saudi Aramco, but then you had the Alibaba Group, 2014, $25 billion. The Agricultural Bank of China was huge. General Motors in 2010, coming out of that bankruptcy to the great financial crisis, that was 20 billion. Visa, Facebook, but this one is going to dwarf all of them. And it's potentially one of many high-profile IPOs coming to the market in 2026. If you talk to private capital investors and people managing private markets and also these investment banks, high hopes. And here's some of them. SpaceX, obviously, we've been talking about it. OpenAI, maybe going public this year at a $1 trillion valuation. ByteDance, the company behind the TikTok, if that ever gets sold. Anthropic might be going public. This is a huge AI company. I know you know it. Databricks, Stripe, big payment processor there. Revolut, digital banking, huge in Europe. And Canva. Just some of the big IPOs anticipated in 2026, unless the stock market fizzles out into a dizzying bear market, and then probably none of these companies are going to be going public, because companies don't like to go public when the markets aren't doing that great. Who would? It's hard enough to be a public company as it is, but the appetite is there, especially for these companies. All right, let's look down the tracks at a very busy and pivotal week for investors. All right, kicking things off on a Monday with markets slightly higher here in the early going, but we have ISM surveys, looking at business activity, manufacturing, and PMI. These are among the surveys Federal Reserve governors and regional bankers look at to see what's actually happening region to region. And then tomorrow, the 7th, the final reading on GDP for the fourth quarter, which was pretty strong to end last year. But going forward, doesn't look as strong. Durable goods orders tomorrow as well. Consumer inflation expectations. By the way, we think inflation's going up and to the right. And then earnings from Levi Strauss, which is complaining about higher oil prices. Yeah, it requires a lot of oil and petroleum products to produce blue jeans. Wednesday, MBA mortgage applications. We know those have been down. We got mortgage rates still at 6.5% for the 30-year here in the U.S. The EIA oil and gas imports and exports. I don't normally list this. We don't normally look at it in times of geopolitical calmness, but because of what's happening in the Straits of Hormuz and in Iran right now, we're going to be seeing how much we're actually importing and exporting from the Energy Information Administration. And then earnings from Delta Airlines, really the beginning of first quarter earnings season. We'll get more next week with the banks, of course, but Delta Airlines, and they've already said they are raising ticket prices, and they'll probably charge some other kinds of fees here and there to make up for these rising oil prices, even though Delta has its own refinery. I remember when it bought that refinery 15 or so years ago. Constellation Brands also out with earnings Wednesday. Thursday, the Fed's preferred gauge of inflation, the PCE, the Personal Consumption Expenditures Index, is out. Won't reflect all these rising oil prices, but it will be a data point for the Fed when it meets in 30 or so days. Personal income reports and then earnings. One of my favorite companies, WD-40, great ticker, WDFC, and BlackBerry. Yeah, still in business Friday. The Consumer Price Index. What is the basket of goods that Americans spend money on costing? That, again, won't reflect this spike in oil prices. But a couple key dates to circle here. Tuesday, the president did give an ultimatum to Iran and said he would bomb them to smithereens, especially their power infrastructure, with an expletive-laden post on Truth Social and some other threats. So we're watching Tuesday, 8 p.m. pretty closely here. And then the rest of the week is going to be all sort of based on what happens with those negotiations. A ceasefire, I would expect markets to rally and oil prices to simmer down, but anything can happen. All right, let's get to our indicator of the week because it has everything to do with economic growth and all these worries about stagflation and a potential recession. And for that, I'd like to look at the Atlanta GDP Now Fed tracker. It's a nowcasting model that provides real-time estimates of U.S. real GDP, not necessarily from the Atlanta Fed, but through the Atlanta Fed. They take all these inputs and they put out this number on a real-time, more or less real-time basis. It shows the real GDP growth estimates for the current quarter. It's updated frequently as new data is released, and it bridges the gap between the official GDP releases, like the one we're going to get this week. Those are delayed. Those are rearview mirror indicators, by estimating growth based on available economic data throughout the quarter. Uses 13 subcomponents, including consumer spending, investment, and trade data, and it follows the same weighting, the chain weightings for those prices, as the Bureau of Economic Analysis. Why do we look at this, and why are we looking at it now? Because we want to see where forecasters think growth is right now, and it's only around 1.6%, especially since the war in Iran began about 6-7 weeks ago, and it's headed down and to the right. So when you hear me and talking about the drumbeat around a recession potentially or stagflation, I'm not making it up. I'm not being Chicken Little this far away from Thanksgiving. Thank you very much. I'm looking at things like this, the GDP Now tracker through the Atlanta Fed. That's a good indicator of where economists think the economy is heading from a growth perspective. So bookmark that one if you're curious. GDP Now, we'll put it in the show notes as well. And one more bonus on the way out. I read it so you didn't have to, but I recommend that you do read it. That is the annual shareholder letter from Jamie Dimon, Chairman and CEO of JP Morgan Chase, one of the biggest banks in the world. Must-read letter, just like Warren Buffett's annual letter used to be. This is one that I pay a lot of attention to. I read it so you didn't have to, but I would like you to take a read or a quick listen to it later, or take my summary. Dimon warning about inflation and interest rate risks. He says that inflation could reaccelerate, potentially leading to higher for longer interest rates and lower asset prices. Geopolitics is a major economic threat. Yes, we agree with you, Mr. Chairman. Conflicts, Ukraine and the Middle East, could drive energy and commodity shocks. Yes, we're feeling that now. He also flags concerns about private credit markets, and we know even that bank is involved in private credits, but Jamie Dimon always a little on the careful side here. Concerns about those weakening underwriting standards. He talks about AI reshaping jobs and business models, seeing it both as an opportunity and a disruption. And while it'll eliminate some roles, it will create new ones requiring workforce adaptation. And then talking about organizing JP Morgan to be more speedy and execute a little bit better and be more agile like Navy SEALs. At the end of the day, he's still optimistic about long-term U.S. economic growth and investment, but he does highlight the fact that we need to put more money into defense and into building out our infrastructure in this country. We'll link to that in the show notes as well. Jamie Dimon's annual letter to shareholders and really the public and folks like us, educated investors. Big thanks to John Kilduff for joining the show. Again, big thanks to Schwab and the Schwab Market Podcast for partnering with us on these episodes as well. As I said, my friends host that podcast, and it's pretty good if you want a good snapshot of what's happening throughout the course of the day. Tap into that and stay tapped into Investopedia.com. Our news team sitting out there, they are all over it. I'm always delighted and surprised at how fast and how accurate and how clear the coverage is from the Investopedia.com news team. Shout out to everyone out there and to all of you for tuning in every Monday at 10 a.m. The Investopedia Express, live and direct, and then on demand on your favorite podcast network. Buckle up. It's going to be a busy week. And we'll talk again a little further on down the line.